We've also got Nouriel Roubini, who's in fact addressing the World Trade Conference. Let's just cut across.
About stopping the financial system led actually to bottoming out of that recession in 2009 and then to an economic recovery. And in addition to the recovery of the economy, there has been also a recovery of financial markets. There's a very sharp correction in US and global equity markets during the crisis. Those equity markets bottomed out in the first half of 2009. And since then, there has been a significant recovery of a variety of risky assets. From the bottom of 2009 until today, global equity markets have gone up on average by more than 100%. So we have a global economic recovery, and we avoided something more severe, like another Great Depression. That's the first point. The second trend in the global economy, I think is very positive, is the rise of the economic, financial, and trading power of emerging market economies. In the next few years, most of global economic growth is going to come from emerging markets. Because even if every country in the world were to grow at potential, and currently advanced economies are growing below potential growth in advanced economies is relatively low, maybe 2.5% in the United States, maybe 1.5% in Europe and Japan and other advanced economies. Per capita income, of course, is much higher in advanced economies, and therefore potential growth is lower. And in advanced economies also, demographic trends like aging of population suggest that potential growth is going to be relatively low. While the potential growth in the average emerging market is much higher. Potential growth in the typical emerging market is around 5%, higher than that in many parts of emerging Asia. And therefore, even if every country in the world were to grow at potential, 5% for emerging markets and maybe 1.5 to 2.5% in advanced economies, a larger share of global GDP and global growth is going to be accounted by emerging markets for many years to come, if not decades to come. Already today, about 50% of global GDP measured on a purchasing power parity basis is accounted by emerging markets, and a larger share of global economic growth is accounted by emerging markets. For example, I do estimate that this year global economic growth is going to be slightly above 3%, but this 3% average is the weighted average of about 5% plus growth in emerging markets and an average of only 1% growth in advanced economies. So a significant share of that 3%, about 3/4 of it, if not more, is accounted by emerging markets. And the fact that the emerging markets are rising and their share of global growth is going to be more significant is a very positive trend for the global economy. It means that many countries that used to be poor are going to become richer. We have already the growth of the middle class in India, in China, in many parts of Asia and other emerging markets. We have many more people being taken out of poverty. And this is going to imply that we're going to have many engines or locomotives of global growth in the global economy, not just the traditional ones that used to be United States, Europe, and Japan. Increasingly, China, India, and other emerging markets are going to be sources of a global economic growth. So that's a positive trend. And of course, this rise in emerging market has many vast implications. There will be a rise, as I pointed out, of the middle class. That means more demand for consumption of goods, consumption of services, more need for infrastructures in emerging markets, more need for real estate, both housing and commercial real estate. And of course, the rapid growth of emerging market implies also a significant demand for many commodities, oil, energy, water, food, higher value-added food, industrial and other raw materials. And of course, one of the important questions in the global economy is if you're going to have this increase in demand for commodities, will the supply of commodities rise sufficiently to make sure that there is not a significant increase in the price of these commodities, something that will be negative for net commodity importers, countries, for example, like China or India. So in emerging markets, the trends are one in which there will be greater urbanization, greater industrialization, population growth and per capita income growth, and all these things are going to imply more demand for goods, for services, for raw materials, for infrastructure, for real estate. And these are going to be drivers of significant economic growth in emerging markets. So we'll have a more balanced global economy compared to the one of the past that was dominated by advanced economies. Of course, as I'll discuss later on, this rise of economic, financial, and trading power also implies a rise of political and geopolitical power. The G7, that was the club of advanced economies that was running the global economy, became obsolete, and now the G20, that includes both half of the advanced economies and the other half, the 10 systemically most important emerging markets, is becoming where global economic policy is being done. So this is not just a shift of economic power, but also of political and geopolitical power. So I think that in terms of longer-term trends for the global economy, the rise of emerging markets, the rise of the rest is going to be one of the most important things is going to be driving the global economy. And that's going to be very positive for the global economy. A third positive trend in the global economy is that while the balance sheets of governments in advanced economies are fragile, too much debt and deficits, while the balance sheets of households in many advanced economies are still fragile because households borrow too much, mortgage debt, personal debt, and so on, and a painful deleveraging is occurring. When you're looking at the balance sheets of the corporate sector, both in advanced economies and emerging markets, they are much more solid. These corporates are restructured after the global financial crisis, have become more efficient, more productive, they've cut costs, productivity growth has been increasing for them, their balance sheets are strong, they've reduced their own debt ratios, their P&L is strong, earnings and profits have been surprising on the upside, and just in the US alone, major corporates are sitting on about $2 trillion of cash balances that they could be used for capital spending, for job hiring, for M&A activities, for foreign direct investment. And that strength of the corporate sector is not just in the United States, but also in other advanced economies, and certainly also in emerging markets. One of the positive trends in the global economy is that now there are significant large multinational corporations, not just in US, Europe, and Japan, but also in emerging markets, from China to India to Brazil, and many of the other emerging market economies. So while foreign direct investment used to be mostly from north to south, the rise of this emerging market multinational implies there is now plenty of foreign direct investment and trade that is also south to south, and even from south to north as well. So the strength of the corporate sector is important, and if these corporates become more confident about the global economic recovery, they do have the financial resources to spend more on job creation, on capital spending, on expanding domestically and externally. And that's a strength of the global economy. A fourth trend that is positive about the global economy has to do with the process of globalization. During the global financial crisis, there was a concern that we will have a retreat from globalization, that protectionism, like in the 1930s, is going to rear its ugly head. Luckily, in spite of that threat, the fact that we avoided another depression and we have had a global economic recovery implies that globalization now is continuing. It's not just more trade in goods and transportation costs being relatively low, there is going to be more trade in goods, but now the information technologies that have been applied to manufacturing are also making able trade in service to become more international. Traditionally, services were considered as non-tradable, but now these information technologies allowed essentially services also to be tradable. And for example, a country like India has been very successful in developing its expertise and comparative advantage in offshoring of a variety of services like IT services that are becoming increasingly tradable. So we have more goods in trade, we have more goods, more trade in services. There is more international capital mobility, both in terms of financial capital moving around the world, and more importantly, real capital moving around the world. Foreign direct investment, global supply chains are becoming more important. So that's another trend of globalization. And in spite of restrictions also to the movements of labor, of course, countries restrict international migration of labor, there is also more international migration of labor. there is more flexibility. People move from country to country to seek better job opportunities, and that's also a positive for the global economy. The fifth element of this greater globalization and increasing trade is not just trade in goods, in services, in capital, in labor, but also more international trade in technology, in information, in news. This digital revolution implies that now technologies can be transferred much more fast from country to country. I remember more than 20 years ago on one of my first trips to India that if you wanted to make a phone call, there were only landlines and you could barely hear from one side to the other of Mumbai. You know, a decade later, everybody in the streets of Mumbai, even poor people, has a cell phone. And that being able to leapfrog technology and going to the frontier of technology in telecom is something that has radically changed the way we work, we live, we do business, and so on. So that's as important as anything else, being able to adopt new technology and absorb them and also innovate, both in advanced economies and emerging markets. So the process of globalization is still ongoing, even if there are threats, and from time to time, downside risks to the global economy suggest that there'll be threats coming from protectionism or restrictions to capital flows. The fifth and positive trend about the global economy is that, as we know, in the long run, economic growth depends not only on population growth, and there is significant population dividend in India and other emerging markets, but also depends on productivity growth, and this productivity growth depends on technological change and innovation. Being able to produce cheaper and better and more productively existing goods and services, but also being able to produce new goods and services, and that's the source of economic growth as well. As I pointed out, the strong economic growth of emerging markets is going to imply significant adoption of existing technologies that are in advanced economies in emerging markets, and that openness to trade, to investment, to technology is going to increase productivity growth in emerging markets. But the other positive trend in the global economy is there is a huge amount of new technological innovation, and that technological innovation doesn't occur anymore only in advanced economies, but even emerging markets like China, India, and others are now innovating in terms of technology. So if we're thinking about the industries of the future, some people think that a lot of the long-term economic growth is going to come from what people refer to as ET, energy technologies, both new versions of fossil fuels like shale gas and oil, or what people refer to as alternative energy, green economy, clean tech, and renewable resources. So there's going to be lots of stuff happening in energy technologies. Secondly, there is still ongoing IT, information technologies that are ongoing and increasing productivity. Web 2.0, Web 3.0, cloud computing, more automation, information technologies and their outsourcing, social media. There's a huge amount of innovation is occurring in information technologies, and countries like India having a comparative advantage in those information technologies. That's going to be a source of strong economic growth and productivity. There is then also BT, or biotechnologies, biomedical research, stem cell research, gene therapy, and application of all these new technologies to healthcare and so on. They're going to probably revolutionize healthcare. There's a lot of stuff happening there. There is MT, manufacturing technologies. There is a huge amount of innovation there. Automation, robotics, 3D printing, personalized manufacturing. That's going to be also significantly change the way we produce goods over time. It's going to be a source of economic growth. So whether the innovation is going to be in ET or BT or IT or MT or any combination of all these things, that innovation is going to continue over time, new industries of the future. And as I pointed out, that innovation is not limited anymore to advanced economies, but a lot of it increasingly is occurring in emerging markets. And for example, India has been a significant innovator in information technologies, and that trend is going to continue. So these are the 5 positive trends in the global economy, and in spite of course, of short-term noise coming from volatility, uncertainty, and downside risk, those trends are going to be certainly important for the global economy as we go ahead. And as countries open up more to trade, to information, to technologies, to capital, to foreign direct investment, those positives over time are going to have a dominant force. Let me now talk about what are the potential downside risks in the global economy and talk about what's happening both in advanced economies and emerging markets. The first observation I'll make is the following one. The recovery of growth in most advanced economies after the global financial crisis has been relatively anemic, subpar, and below trend. As I said, this year, the average economic growth in advanced economies is going to be barely 1%, slightly better than the United States, much worse in Europe and so on, but it's going to be relatively mediocre. And why growth recovery has been so weak in advanced economies? It's been so weak because this was not a typical recession, but was a recession caused by a financial crisis, and a financial crisis caused initially by too much debt, leverage, and risk-taking by the private sector, too much debt and leverage by households, by banks, by other financial institutions. But now, as a result of the policy response to the global financial crisis, there has been a huge increase in public debt and deficits in advanced economies. The median debt to GDP ratio in the public sector before the crisis in advanced economies was 60%. Today is closer to 100% of GDP. So we started with too much private debt, and now we ended up with too much public debt. And history, economic research, and studies suggest that whenever you're coming from a balance sheet crisis, too much debt and leverage in the private and public sector, there's a painful process of deleveraging that implies slow economic growth for up to a decade. Why? If you have too much debt, you have to spend less in the private and public sector to save more or save less in order to gradually reduce to more sustainable level those debt ratios, and that lower spending and higher saving in the short run implies a drag on economic growth. That's why in the United States, in the Eurozone, in the UK, in Japan, in most of other advanced economies, the recovery from the global financial crisis has been so weak, and that process of deleveraging is still ongoing in most advanced economies. The recovery from the global financial crisis in emerging markets has been much more robust. Yes, there was a sharp slowdown in 2008 and 2009. Some emerging markets even had a mild recession. Most of them avoided the recession. But since then, the recovery has been V-shaped with a rapid return towards potential growth in most emerging markets. Why is that the case? In most emerging markets, as I pointed out, potential growth is much higher than advanced economies. In most emerging markets, with some exceptions, the balance sheet problems of too much private and public debt that have been affecting the growth recovery of advanced economies are less. So there has been a faster recovery because there is less burden of private and public debt. And the ability of this emerging market to stimulate their own growth, given the slowdown with monetary and fiscal stimulus, has been stronger than advanced economies because their balance sheets were better and their own macro conditions were better. So while the recovery in most advanced economies has been more like a U-shaped recovery, with very slow recovery of growth, in most emerging markets it's been more like a V. It was a contraction or a slowdown for a year or so, but a rapid return to potential growth. So emerging markets today are growing close to potential, 5% plus, while advanced economies are still growing at below potential, 1%. That's the difference that we see. It's a multi-speed global economic recovery. So in advanced economies, we have, first of all, slow economic recovery because of this painful deleveraging. And within advanced economies right now, the condition of some of these advanced economies, it's even weaker. We have had last year an economic recession and a severe fiscal and financial problems in the Eurozone. We have also near recession in the United Kingdom, and until recently, we'll see what are going to be the effects of these new policies in Japan. Even Japan has had very anemic economic growth, outright actually recession last year, and deflation. So let me talk about first specifically about some of these advanced economies, and then I'm going to talk about the prospects for some of the emerging markets. Now, of all the tail risk in the global economy, the one deriving from the situation in Europe and specifically in the Eurozone, that one is the most severe in terms of tail risk. The good news compared to a year ago is that the tail risk of the Eurozone have been reduced. In the spring of last year, people were worrying about a Greek exit from the Eurozone, about even a breakup of the Eurozone, about Italy and Spain losing market access and needing a bailout program. Those tail risks today are lower than a year ago for a number of reasons. First of all, the decision of the European Central Bank of doing whatever it takes to keep the Eurozone together and the creation of this new OMT program to backstopping the debt of the governments in the periphery has reduced significantly the interest rates and the spreads on government debt in Italy and Spain and most of the periphery of the Eurozone. That's the most important factor. We've reduced the tail risk of a breakup. Secondly, the passage of the ESM, that is a pot of 500 billion euros of money available to backstop sovereigns and banks, has also helped restoring confidence in the Eurozone. Three, the Europeans realized that the monetary union was incomplete. You cannot just have a common currency, and there is now talk and some progress about a banking union, a fiscal union, a political union, economic union. And fourth, the attitude of Germany towards the periphery of the Eurozone has changed. The Germans realized that you could not have an orderly exit of Greece without having massive contagion to Italy and Spain until Italy and Spain are successfully ring-fenced and backstop. And the Germans also realized that the Eurozone project is not just an economic project, but is also a political project. So these four factors have reduced those tail risks. And certainly that's important, because if you had had disorderly defaults, if not exit of some countries, the global shocks to the global economy would have been severe. And one of the main reasons why global economic growth, even in emerging markets, had slowed down last year was that the tail risk of the problems of the Eurozone had led to a significant increase in global risk aversion, negatively affecting trade, economic growth, and also the behavior of financial markets. So it's important that that tail risk has been reduced. While that tail risk has been reduced, fundamental problems of the periphery of the Eurozone remain unresolved. There are at least four problems in the periphery of the Eurozone. The first one is that potential growth in the periphery of the Eurozone is still low, and is low for two reasons. One is that there is demographic trends that are negative, aging of population, that reduces potential growth. Secondly, productivity growth in most of the periphery of the Eurozone is still low because structural reform to increase productivity growth have been occurring very slowly. So potential growth in the periphery of the Eurozone is low. Secondly, there is still ongoing recession in the periphery of the Eurozone. Those countries in the periphery that were in trouble, Greece, Ireland, Portugal, Italy, Spain, now Cyprus and Slovenia, are still mostly contracting. And that economic contraction right now is also spreading to the core of the Eurozone. France this year is going to have an economic contraction. The latest forward-looking indicators of manufacturing activity, even in a strong country like Germany, suggest a very sharp slowdown of manufacturing, even in Germany. And what are the reasons why this recession in the periphery of the Eurozone is continuing? I think there are four of them. First of all, there is still front-loaded fiscal austerity. And while that fiscal austerity might be necessary to avoid the debt crisis, in the short run, raising taxes implies reducing disposable income, and in the short run, cutting government spending, even inefficient government spending, reduces aggregate demand. So you're reducing disposable income, you're reducing aggregate demand. No wonder that that front-loaded austerity has a negative effect on economic growth. Secondly, the value of the euro is still too strong for the periphery. In the peripheral Eurozone, unit labor costs rose sharply in the last decade because wages were growing more than productivity. A euro at 130 relative to the US dollar is fine for Germany, that is uber competitive. Germany can live with a euro at 130, 140, even 150. But for the periphery of the Eurozone, where unit labor costs rose 30, 40%, the value of the euro would have to be 20 or 30% lower to restore the competitiveness. For many reasons, the euro is too strong. That doesn't help the recovery of growth. Third, there is still a severe credit crunch in the periphery of the Eurozone, where banks don't have enough capital, and they're trying to achieve their desired Basel capital ratio by selling assets and contracting credit. That credit crunch is hurting small and medium-sized enterprises. Firms that are illiquid but solvent could become insolvent if this credit crunch is not resolved. And 4, with rising unemployment and falling economic activity, business and consumer confidence is still very low, and animal spirit and confidence are really down, and that doesn't help, of course, the recovery. So in the peripheral Eurozone, you have low potential growth and outright recession. Third problem is that you still have very high and rising debt ratios, private debt ratios, public debt ratios, domestic and foreign debt ratios. And the fact that the debt to GDP ratio depends not just on the numerator, but also the denominator. If that denominator is GDP keeps on falling, you can work out as much as you want on the numerator, but you're not going to be resolved that dynamics. And the fourth problem of the Eurozone is the lack and loss of external competitiveness. That rise in unit labor costs led to large current account deficits. Those deficits have been shrinking only because there is a recession. The structural deficit remain the same, and the strength of the euro doesn't help restoring that competitiveness. So unfortunately, in the periphery of Eurozone, there is this toxic nexus between low potential growth, outright recession, high and rising debt ratios, and still lack and loss of external competitiveness. And it's going to take many years to resolve these problems, if any time. So the outlook for the Eurozone remains still extremely fragile in many ways. And the talk about the banking, fiscal, and political union to complete the monetary union, most of it is still talk. There is not any progress on political union. Any idea about the fiscal union is frozen. And of the main elements of a banking union, the only progress has been done so far on having a common supervisor, the European Central Bank, but even that is going to become operational only a year and a half from now. The other elements of the banking union for the time being are frozen. So those fundamental problems of the Eurozone remain. So unfortunately, the recession in the Eurozone is not going to bottom out anytime soon, and therefore that's going to be a drag on global economic growth. Let me now speak about the United States. The United States is still the largest economy in the world, and what happens in the US, of course, matters for global economic growth. There are some positive news in the US, and there are also some negative ones. The positive about the United States are that the housing and real estate recession has bottomed out, and now there is a recovery of quantities and of prices. That's a positive. The second positive about the United States is this shale gas and oil revolution is going to be very beneficial for the United States. It's going to reduce energy costs, and it's going to lead to increases in productivity in many energy-intensive sectors like the chemical industry and other ones. The third positive about the United States is there is some beginning of reshoring of manufacturing in the United States. That reshoring of manufacturing is driven by at least 3 factors. One is the reduction in energy cost through the shale revolution. The second one is that some costs in emerging markets, say in China, are rising, like labor costs, and therefore some reshoring of manufacturing is beneficial. And the third one is that the third manufacturing revolution is very capital intensive and labor saving, based on automation, robotics, and so on. And therefore, if the cost of labor is going to be a lower share of the total cost of production, because a lot of manufacturing is becoming capital intensive, then bringing back manufacturing in the United States is going to be positive. So those are leading to a recovery of manufacturing. Fourth positive about the United States is there is some improvement, however slowly, in the labor market with job creation. And the fifth one is that monetary policy remains easy in the United States with quantitative easing by the Fed. That quantitative easing is leading to asset reflation in the stock market and a relatively easy condition in credit markets. And that asset reflation is also boosting through a variety of channels, bond channels, credit channels, some restoration of economic growth. Those are the positives about the United States. What are the concerns about the United States? There are several. In the United States, the fiscal consolidation this year is becoming excessively front-loaded. There was an agreement at the beginning of the year to raise income taxes and payroll taxes, and now, given the gridlock in Congress, there is sequestration of spending. Between increasing taxes and cutting spending, this year we're going to have something like a $300 billion fiscal adjustment, or 2% of GDP, with a fiscal drag that's going to be at least 1.5% of GDP. So in my baseline for the United States, economic growth in the US is not going to be much more than 1.6, 1.7%, when potential growth in the US is more like 2.5%. For a while, people were becoming very optimistic about the US, saying this year is going to be a strong recovery of economic growth. They were downplaying the fiscal drag, and for a couple of months, in spite of the rising taxes, consumption was still robust. But the latest number from March actually are showing that the increase in the payroll tax and other taxes is having now a biting effect on consumption and on disposable income. And now the additional effects are going to be affecting the economy out of the spending sequestration are going to be a further drag on economic growth. So I think that actually markets might be surprised by how much slowdown in economic growth that fiscal drag in the United States that is excessive is going to imply. Now, the paradox of the United States is that you have too much of a fiscal drag in the short run, but you don't have any plan for medium-term fiscal sustainability, because the medium-term fiscal trends of the US are still negative. And the gridlock in the United States is one in which there is one party, the Republican, that is against any additional tax increases, and there's one party, the Democrat, that is against spending cuts, especially reform that is necessary of entitlements, healthcare, pension spending, and so on. And so this reciprocal veto implies that there is no real plan for medium-term fiscal consolidation. And while the United States can still finance itself cheaply in the short run, being the largest economy in the world and being a reserve currency, if these medium-term fiscal issues are not going to be addressed.
Okay, that's Nouriel Roubini, the man who was dubbed Dr. Doom at the onset of the financial crisis. He finally believes that the US market and the US labor and housing market both are seeing a bit of a turnaround. But of course, the Eurozone, he believes we haven't yet seen a bottom on that market right now. However, he also emphasized on the importance of the emerging markets and said that over the next year or so, for now, you have about 50% of the global GDP and the growth numbers which are contributed by the emerging markets, and that's likely to continue to increase as we go ahead. But we'll take you through the top headlines of the hour before we move ahead.
And going